Our guest claims or argues that stock valuations are high, and that's perfectly fine. Let's bring in Alec Young, Chief Investment Strategist at MapSignals. Thanks very much indeed for joining us.
Thank you for having me.
I love that. You say, yes, stocks aren't cheap, but really that's not a reason to worry excessively.
No, we don't think it is. We've been quite constructive on this market for the last couple of years. And we look back at history and we asked ourselves, with everyone worrying that valuations are stretched or too high, when historically have we seen PEs contract? And it turns out you really need a recession. You need a hawkish Fed. You need weak earnings growth. We actually have the opposite today. There's not much worry about recession right now. The U.S. economy is in good shape. Earnings are growing, expected to grow 14% in 2025 over 24. That's versus a 7% long-term average growth for earnings. So we're expected to be growing earnings at roughly double the long-term rate. And as far as the Fed goes, while a slowdown in disinflation means the Fed is likely to cut less often than people expected a few months ago, they're still not done cutting policy. We point out in our latest report that the real Fed funds rate, so if you subtract inflation from the Fed funds rate, you get about 1.5%. Going back to 1960, that's averaged about 1%. So policy is still restrictive from the Fed. So we do continue to expect a couple of rate cuts this year. And, a dovish Fed, above average earnings growth, and a healthy economy, you generally don't see a lot of multiple contraction in U.S. stocks during those types of macro environments.
Speaking of macroeconomic signals, you reckon there are some bullish indicators that the market is discounting unduly?
I think that these are bullish indicators that the market that the bears are overly discounting, I guess might be a better way to put it. So the factors that I just cited are just reasons not to expect PEs to really come down a lot anytime soon. You need signs of a recession, a hawkish Fed. We just don't have those things right now.
Sorry, yeah, I may have, they call me the confuser, and I probably put the question to you rather awkwardly. Okay. Return to valuations here, though, because I think you began by saying that we do look set for pretty substantial earnings growth ahead.
Yes, and that should support what are elevated valuations historically, largely because of high tech valuations. But tech now dominates the S&P. It's a third of the S&P. So because of that, the S&P 500 is trading at 22 times estimated earnings for 2025. That's versus a 17 long-term average multiple. So it is well above average, but that's because tech's influence has grown. And tech's earnings are expected to grow in the mid 20% range versus 14% for the broader market. So yes, tech is expensive at 30 times compared to the market at 22, but that's because the earnings are growing substantially faster than the rest of the market. When we look beyond tech, at small caps, mid caps, the S&P equal weight, where we weight every company in the index the same and reduce the impact of the big tech stocks, the valuations are 16 or 17 times, which is in line with history. So, there's really the elevated valuation discussion is really about big tech, and those valuations are justified by faster profit growth. So, we just wanted to get out there and address this refrain that we were hearing from a lot of clients and investors on Wall Street about valuation.
Cyclical sectors you think are a decent bet at this stage, including tech and financials and consumer discretionary?
Yes, in our 2025 outlook, we talked about how we favored cyclicals for 2025, and we think that tech, financials, and discretionary are at the top of the list. We got a lot of earnings from some of the big banks kicking off the earnings season this morning: J.P. Morgan, Goldman, BlackRock. Blackstone. I mean, the numbers are very impressive, and we expect more of the same as we hear from more financials over the next few days. So definitely think that with the economy in good shape, the Fed continuing to ease, there's a strong cyclical impulse in the economy. There's deregulation hopes with the new administration. There are concerns about tariffs. We think tariffs will wind up being better than feared. People are very negative on the topic, and we think whatever winds up happening will be less bad than what a lot of people had been worrying about. So all of this should be a healthy tonic for the economy, and that means we want to lean into cyclical areas. So tech, financials, discretionary are some of our favorite areas right now.
It's interesting. I know it's impossible to predict or even to guess in some cases what Mr. Trump will do. But you think that, for example, could he phase in tariffs?
Exactly. We think that he's going to be much more targeted and surgical about applying them. And then when he does decide to apply them, they may use phase-ins to mitigate the potential inflationary impact, because they're very attuned to that concern, given the recent rise in interest rates and inflation concerns. I think the administration is going to want to be sensitive to that, while at the same time imposing the tariffs that they want to impose. But generally speaking, investors have just gotten so scared about widespread tariffs, very large tariffs on Mexico, Canada, China, that we think what's likely to actually come to pass is probably going to be better than feared. And stocks don't move on whether things are good or bad. They move on whether they're better or worse than expectations. And the expectations on tariffs are so bad that we think stocks will move up when the reality turns out to be better than feared.
Thank you very much indeed for joining us. Alec Young, Chief